The next kind of stock we got to talk about is something called preferred stock. It is another class of stock that we have. Okay. Really, the reason it's preferred is for two big reasons. The first is that they usually have the first rights to dividends if and when they are paid. So what'll happen is on occasion, a company may not pay dividends for 2 or 3 years. And for common stockholders, that's no bueno because you just don't get paid a dividend. But for preferred stockholders, most typically, they're going to get what is called dividends in arrears. So before that company can pay the common stockholders any dividends at all, they have to pay 3 years worth of dividends to the preferred stockholders. And preferred stock is priced differently as far as how dividends are concerned. You will see preferred stock listed as at a certain percent, at 5%, at 10% preferred stock. What that means is instead of a solid dollar amount that you pay per dividend or per share, you're going to pay a percent of whatever the fair value or the market value of that stock is per share. Okay. The second one is that you receive preference over common stockholders if the company is dissolved. If a company goes into bankruptcy and they have to liquidate, preferred stockholders are higher up on the list to receive assets in a case of liquidation. So the way we account for the issuance of preferred stock is the same as we accounted for the issuance of common stock. We issue 1,000 shares of $30 par value preferred stock at $40 per share. We're going to increase our cash asset by $40,000 because, hey, they gave us 40 grand in cash. And we are going to increase our contributed capital preferred stock account by 30,000, the par value. Remember, we only ever record common and preferred stock at par value. And then the difference is over and above what we say it's worth, so it goes into the additional paid in capital account. Capital that's been paid in addition to what we said the stock was worth. Okay. This is what your journal entry would look like. Notice again, if we just stopped at the preferred stock being recorded at par value, we would be short. Our debits would not equal our credits, so we have that additional paid in capital, that difference. Okay. So dividends for preferred stock. Companies that issue preferred stock generally commit to pay dividends to preferred shareholders. They have a fixed preset dividend rate and they are paid quarterly. Okay. The way that you're going to calculate that is you're going to take your par value times the dividend rate, and that is your preferred dividend per share. So like I said, if it's a $10 par value, you multiply that times 10%, that's $8. Okay. And it will be that forever. This table, again, I would stop, screenshot, print it, just be familiar with it. It's going to tell you the differences between your equity and your debt, right? So what's the difference between common stock, preferred stock, and bonds, okay? What are your voting rights? Well, you don't have any with bonds. You typically don't have any with preferred stock, but you get them with common stock. What's your risk? What's your expected return? All of that good stuff. This is, again, a table full of really good conceptual questions. Let's talk about treasury stock. This is where some people get confused. Treasury stock can get a little confusing, but if you just think about what you're doing, I think it helps kind of alleviate some of that confusion. So you can repurchase your own stock, and there are a million reasons why you might do that. Okay, you may want to boost underpriced stock, right? This is just a simple supply and demand concept. If your stock is in demand and you want to drive the price up, what do? You cut the supply. Okay. You may want to distribute cash to your shareholders without actually paying a dividend. Why would you want to do this? Well, because cash that's distributed to you from the corporation is a capital gain, whereas, I should restate that. Cash distributed to you by the corporation because they repurchased the stock from you is a capital gain, and that gets treated differently in tax than getting paid a dividend does. So sometimes you want to get cash to your shareholders without paying them a dividend. You may want to boost your earnings per share, right? The earnings per share calculation is your price, your market value divided by the number of shares you have. So the higher that is, the higher your earnings per share is going to be. And when the EPS is one thing that investors look at quite frequently. They think that a higher EPS is a signal of a healthier company. Okay. You may have to satisfy some employee stock ownership plans. There are businesses that are owned 100% by employees, and part of that compensation package is that they get to vest in shares of the company. And occasionally they are able to sell those shares, and you may want to repurchase some of those shares to distribute stock to other owners in the company. Okay. When we issue shares of stock, it increases stockholders' equity because stockholders' equity is a representation of other people's ownership in our company, right? So it stands to reason that when we buy those stock back and they become treasury stock, it decreases stockholders' equity, okay? So rather than reducing the common stock account or the preferred stock account directly, we're simply going to create this new classification of stock called treasury stock. And that is going to be a contra equity account. When we purchase treasury stock, it reduces equity. So it is a contra equity account. And as such, it holds a debit normal balance. Okay. Please remember this. Treasury is not an equity investment. We are not purchasing equity in another company. We're not even purchasing equity in ourselves. It is our purchase of our own stock. It is diluting the amount of equity that we actually have. So it is a reduction of stockholders' equity. Okay. So let's take a look at an example here. Let's assume that we repurchased 100 shares of the 1 cent par value common stock, but we paid $30 per share for it. So we're going to record it at what we paid for it. That's important. You record it at what you paid for it, not what its par value is. You record treasury stock at its purchase price. So here we're going to reduce assets by $3,000. We're going to increase treasury stock by $3,000, which actually turns into a reduction of stockholders' equity, right? Because it's a contra equity account. So increase the treasury stock, decrease the cash. This is important to note that you record the treasury stock that you repurchase at cost. Okay. Now, this is what your balance sheet's going to look like. Okay. After all this is done, the partial stockholders' equity section of your balance sheet looks like this. Okay. So be familiar with that. You may see that in some exam questions. If you do, it won't be this complicated though. So let's talk about reselling treasury stock. Occasionally, once you've purchased the treasury stock and it's done what you intended it to do, you're going to resell that treasury stock. After all, you want to generate more capital. And what's one way we can do that? Well, by issuing stock. If we have treasury stock sitting in the bucket, why not reissue it and get some money for it? Hopefully, that's the hope. Okay. So let's say we resell that 100 shares of treasury stock for $35. Remember, we paid $30 for them. We recorded them on our books at $30 per share. We're going to sell them for $35 per share. Okay. So what that's going to do is basically give us kind of like a gain, right? We're going to take that proceeds, $35, reduce it by the book value or par value, or what we paid for it, that purchase price, $30. So you get a positive $5. Multiply that times 100, and that's going to give you a $500 increase to your additional paid-in capital. You're going to put that in your APIC account because it is capital that's been paid in addition to what you said it was worth. You said it was worth 30, you sold it for 35. It stands to reason that that extra $5 has to go into your additional paid-in capital account. You notice we increased cash by $3,500. That's the 100 shares times 35. We're going to increase or decrease our treasury stock, by $3,000, 100 times the purchase price, 30. And we're going to increase the additional paid-in capital account by $500. Okay. So at the end of the day, we have a net positive $3,500 for assets and stockholders' equity. Remember, we resold this. This is going to increase stockholders' equity. Okay. Let's talk about selling it below cost. Occasionally, you will have to resell treasury stock for below cost. Okay. Let's assume that we sell that same 100 shares of treasury stock for $25 rather than $35. Remember, we originally purchased these back or repurchased these for $30. So take your proceeds, 25, less your par value of 30. It's going to give you a negative $5. Take that negative 5, multiply it times 100, and here you have your negative 5 additional paid-in capital. Okay, so conversely, you could take your 30 times 100. That's how much you're going to have to reduce your treasury stock by. Take your 25 times your 100. That's how much you're going to increase your cash by. The difference is going to be your additional paid-in capital. Okay. Notice here it's a reduction in paid-in capital. So yes, this is the question I very typically get asked is, can you ever reduce additional paid-in capital? Yes, you can. When you sell treasury stock for less than what you bought it for, you're going to reduce your additional paid-in capital. Okay. So earned capital. This is going to be retained earnings. That's what we're going to talk about here. Okay, retained earnings are the net income that we get to keep after we pay dividends, and that is why we have this formula here. Retained earnings equals net income less dividends. Write that down. Remember it. You're going to be expected to calculate it at some point on the exams. So it holds a normal credit balance since it's a piece of equity. It's an equity component, so it holds a normal credit balance. It's on the right-hand side of the equation. It increases equity, holds a normal credit balance. Okay. Recall, this is a permanent account. When it comes time to close the books, we do not close retained earnings. Retained earnings stays open. We simply roll that balance forward each month. Okay, so here you can see negative $1,000. So a $1,000 loss in year one. We didn't pay any dividends. Year two, we had $3,000 in net income. Okay, didn't pay any dividends. So now our aggregate is $2,000. We have $2,000 in retained earnings. Negative $1,000 plus $3,000 equals $2,000. Year three, we got $4,000 in net income. We paid $1,000 in dividends, so we're going to add the difference to our retained earnings, and that's $5,000, so on and so forth. Okay, just remember, that's the important thing to remember. Retained earnings is net income less dividends, and it is a permanent account that rolls forward each period. Okay, cash dividends, these are very easy to understand. Typically, when you distribute dividends, you distribute them to the stockholders in the form of cash. Occasionally, you can distribute them differently. Sometimes you may distribute them as stock dividends, like so instead of paying cash, you may give them more stock. Okay. So what we need to know about cash dividends are the three very important dates that you have to be aware of when we talk about cash dividends. The first is the declaration date. Okay, this is the date of which the board of directors declares the next dividend will be paid. And there is a big note here. Note that once you declare a dividend, it is as good as paid. You have to record the dividend payable on your books on the date of declaration. Okay. On the date of record, that is when the company looks at the records to determine who the stockholders are. So this is essentially saying you have to have owned stock as of this date in order to receive the dividend. That is your date of record. And then you have your payment date, the date that you actually distribute the dividend, when you actually pay the cash. This is where you will reduce your dividend payable and reduce your cash. Okay. So let's talk about recording the dividends on the date of declaration. Okay, so on March 26th, they declared 25-cent per share dividend on 2,000 outstanding shares. So we're going to take that 2,000, multiply it times 25 cents, and that is going to become our new dividend payable. Okay, so we're going to increase dividends right here. Okay, remember, dividends is not an expense. It is not part of the net income calculation. It's actually taken from net income, so it's not an expense. It is its own thing. But since the day of declaration, they're as good as paid, we're going to go ahead and recognize the dividends. That's 2,000 times 25, or times 0.25. That gives us a $500 dividend. We're going to record that payable to remind ourselves that at some point in the future, we are going to have to pay $500 in cash. Okay. So here's the date of payment. Let's say that they're going to make this payment on April 15th to stockholders of record as of March 31st. So we're going to reduce our dividends payable by 500. This, remember, was just to remind us that we had to pay it. And then we're going to reduce our cash by 500 as well. Okay. So just remember, this transaction, this is not an expense. This is not an expense. Dividends are not an expense. They are their own thing. Dividends are dividends. Okay. They close directly to retained earnings and not to net income like revenues and expenses do. So equity analysis. Let's talk about return on equity. Okay, so this is essentially going to say for every dollar of average stockholder, or for every dollar of stockholders' equity I have, how much of that's getting returned to me in the form of net income. Okay, this is good to look at because it tells us, are they leveraging their equity very well? Okay, so let's take a look at an example of Facebook and IBM. Here, this is a good example of what you might see on an exam asking you questions to calculate certain ratios. You're going to get two companies and then you're going to get a bunch of information. Your job will be to determine what do you need to know. Well, we know that a return on equity is your net income divided by your average stockholders' equity. So you're going to take your beginning, add in your ending, divide it by 2, and that gets you your average. So let's take a look at return on equity for these two different companies. Facebook has a 27.9% equity. return on equity. IBM has a 68.5% return on equity. So we can see Facebook's is quite a bit lower. What that tells me, just initial gut feeling, is that IBM is much more heavily debt leveraged. Or excuse me, Facebook is much more heavily debt leveraged than IBM is. IBM is much more heavily equity leveraged. So they're selling a lot more shares to the public than Facebook is, right? And we know that to be true because Facebook only went public a few years ago. So they probably don't have quite as much as IBM does that's been around for years and years and years. Okay. The next one we got to talk about is dividend yield. The way you're going to find this is your dividend per share divided by your stock price. What this tells you is how much is the company paying out in dividends compared to its stock price? Is it worth it? The higher, the better, right? So here we can say Facebook is paying no dividends, so their dividend yield is 0, while IBM is paying out $6 in dividends, and their stock price is 113.67. So what this is telling me is that if I buy a share of stock, 5.5% of that is being returned to me. So really, I can consider the stock to cost me $107.67 instead of $113 because I can take that $6, reinvest it, whatever the case is. Okay. And finally, we have earnings per share. This is going to be your net income less dividends on preferred stock. Again, we do not take preferred stock into consideration when we're calculating earnings per share. We talked about this number early on in the semester, and we just said it's net income divided by the average shares outstanding. For us, now we realize there are more parts to equity than just the number of shares you have. So we're going to take net income. We're going to reduce that by the dividends that you pay on preferred stock. Okay, we're not worried about preferred stock. We're only worried about common stock. We're going to divide that by the average shares of common stock outstanding. So calculation you may have to make, right? Understand what outstanding means. It means shares that are in the hands of third parties. It does not include shares that we own. It does not include treasury stock. Why? Well, because we're not going to pay ourselves a dividend, right? We're not paying dividends on treasury stock. And then finally, we have the price earnings ratio. Essentially what this does is it tells us the higher this number is, the more confident the market is in your ability to give a return to your investors. Okay, usually these are anywhere between 15 and 25. The higher the PE ratio, the higher the hopes the company has, or excuse me, the higher the hopes the stock market has for the company. Okay, this can help drive the price up. The higher your PE ratio, the higher you can drive your stock price. Okay, so to find this, you're going to take your stock price and you're going to divide it by earnings per share. Notice we have earnings per share here. This could be a pretty good indicator that we're going to ask you to back into some more numbers on occasion. Okay, so if we look here, we see that Facebook's price earnings ratio is 17.16 and IBM's is 8.68. What this says is that the market's just a little more confident in Facebook's ability to return on the investment. So that is it. So if you have any questions, please contact me and let me know.